Hello, this video will be an overview of debt instruments. We're going to discuss investments by corporations, and corporations like to make investments if they have the cash to do so they can either earn a return on their investment, just like we like to earn a return on our investment if we make any, and that return will come in the form of either dividends or interest when their when the market price of their investment increases. So that's one reason companies invest in other companies or bonds. They also can invest to develop ongoing affiliations with those companies, or they can develop strategic relationships, and so therefore they're going to have a huge investment in a specific company. There are two types of investments corporations can enter, and those are equity securities, and that's when one company purchases the common stock or preferred stock of another company, or they can enter into debt securities, or we call them debt investments, and they do that by either purchasing bonds or notes as investments. The difference, and we're going to be focusing on this during this video, just a high-level overview, and then in future videos we'll get into how to account for very specific types of debt investments or debt securities. But in general, the difference between a bond and a note is that bonds are usually long-term and they're publicly traded, and notes are typically short-term or long-term, and you just get them from privately through other companies. The way that the accounting is prepared for these investments, depending whether it's a debt or equity, will also depend if we plan on selling the debt or not selling the debt. And I'm not going to go into the different valuation approaches because this will all be covered in other videos. But in general, when a company invests in a debt security, it is basically buying a bond or a note from another company or the government or some institution, and they pay that institution. So this is Corporation X pays Corporation Y money, right? Some amount, and in turn, Corporation Y will give that money back to X plus interest at a future date. And the debt security, it specifies the date when it matures, meaning the date when Corporation Y will give money back to the Corporation X. It will specify the amount, the principal amount, and it'll specify the interest amounts that are paid to Corporation X, who is the investor. And the principal and the interest payments are considered to be a stream of cash flows that the investor receives in the future in exchange for purchasing a bond today, right? So in exchange for purchasing a bond today, right, where X gives Y the money, Y gives back X the principal and interest payments sometime in the future. There are four main characteristics for in the life of a debt investment. Number one is the company has to purchase the debt investment. The second one is that they receive periodic interest payments per their agreement. And then, so the first two characteristics, we account for them the same way no matter what kind of debt investment a company holds. And again, there's going to be three different kinds of debt investments, and we'll go through that in future videos. But these first two bullet points are accounted for the same no matter which debt investment you have, the company holds. The third characteristic is that the debt investment changes a value while the company holds investment, and therefore the company, the investor, can record unrealized holding gains and losses depending on, again, the type of debt instrument that they hold. And the fourth characteristic will determine how to account for debt investment, and again, depending on the type, and it depends whether the company decides to sell the debt investment before maturity, meaning they'll hold it for short term, or are they gonna, or is their intent to hold it the whole time until the debt investment matures. When a company invests in a bond, it says bonds, but it's really a bond or a note that they buy from another institution. The fair value of that debt instrument will change when the market interest rates change. It's just kind of like when you buy a stock and the stock value changes as the market changes. Same thing with investment. The fair value of your investment of the bond or the note payable, I shouldn't say note payable, of the note will change as the market interest changes. So bonds and notes are sold, typically they could be sold at par value, which means their face value is the same. So if you buy a $700,000 bond, you pay $700,000 for it. But typically that's not the case. Typically bonds are sold either at a premium or at a discount. So when your interest rate is, when the stated interest rate on the bond is higher than the market rate, then it's sold at a premium. So if my stated interest rate on the bond is 10% and the market rate is 8%, then it's going to be sold at a premium. The stated rate determines the interest payments that you will receive as an investor over a period of time, whether that's annually or semi-annually. And the market rate is exactly what those bonds are being sold for in the open market. So if you're getting an interest rate of 10%, but the market rate of what you would get if you were trying to shop for it is 8%, you're going to have to pay, company X is going to have to pay company Y more than the face value of the bond because they're getting a higher interest rate. Opposite of that is when your interest rate is lower, right? So if my interest rate was 8%, but the market rate is 10%, so that means the interest payments that I am receiving as an investor on this bond is going to be lower than if I were to go buy a bond on the open market. And so the only way to entice an investor to actually buy these bonds is to sell them at a discount. So if you get selling a $700,000 bond, you might have to sell it at $650,000. And there's ways to calculate, very specific ways how to calculate this, which is what we're going to learn in this video. Here's an example for a bond purchased at a discount. So again, when we say bonds purchased, this is company X is purchasing a bond from company Y, and then company Y is going to pay back that face value plus interest to company X. Okay. On July 1, Masterwear Industries issued 700,000 of 12% bonds dated July 1. Interest of $42,000 is payable semi-annually on June 30th and December 31. The bonds mature in 3 years on June 30th, 2030. United Intergroup Inc. purchased the entire bond issue on a date when the market interest rate for bonds similar risk and maturity was 14%. So Masterwear in this situation is Corporation Y. They're the ones who are selling the bonds, and United Intergroup is Corporation X. They're the ones who are buying the bond, paying Masterwear a certain amount, and then in return they'll get interest payments plus $700,000 at the end of the 3 years. This bond, so the stated interest rate is the interest payments on the bond, which is 12%. The market rate is 14%. So if I were to go shop out on the open market, I can get a 14% interest on this bond, but MasterWare is only going to pay me 12. So in order to entice me to buy this bond, they're going to have to give me a discount. This $700,000 bond, I'm not going to give them $700,000 for it today. I'm going to give them an amount less than that. And the way you do that is you have to present value all the principal, the face amount, and the interest payments. So the interest payments we're told are $42,000, right? We're told that here. And they're payable semi-annually on June 30th and 31st. And it is a 3-year bond, which means that our number of times we will receive interest is 6. So when we go to the present value of a dollar table, the present value of an ordinary annuity table, the number of periods is 6. And the interest rate, because we get paid twice a year, is going to be cut in half. And notice when we present value it, we're going to use the market rate to present value the interest payments. So when we look at the interest, we're going to take the interest payment times that present value, and that gives us a $200,195 present value. I want to also point out that the $42,000 interest payment is calculated by taking the face value of the bond times the stated interest rate, which is 12%, times 6 over 12, because we're going to basically get a payment every 6 months, right? We're going to get paid this payment. That's how the $42,000 is calculated, and then we present value that using the ordinary annuity to get the $200,000. We have to also present value the actual face value of the bond, and I'm going to erase some of this just to make kind of more room so it's not as messy. And so we're going to take the $700,000, and that one we're going to present value using a dollar table, because we're going to get that lump sum in the future in 3 years, but even though it's 3 years, it's the number of periods is 6 because we get paid semi-annually. And again, our interest rate is cut in half. And again, this is using the market interest rate, not the stated interest rate. So we present value the 700,000, and when we add the two present values together, we get 666,633, which means this is what we're going to pay for company X. This is the amount we're going to pay company Y for this specific $700,000 bond. And this is how we're going to record it on our books. We are we have investment in bond, and this is going to be the face value, right? The face value of the bond, or the principal amount. That's the same thing. We're going to give the company, right, $666,000 in cash for that $700,000 bond. And we got a discount on that bond because the market interest rate was higher than the stated. So we have a discount, and we're going to book this discount on bond investment for, it's the plug, it's the $33,000. This discount on bond investment is going to be a contra asset account to the investment account. So when we present it on the financial statements, when we present it on the financial statements, we are going to say, either investment, and then we can say less discount and we can present it like this, minus 33,367 to show on the face of our financials like this, or we might say investment net of discount, and then just show the 666,000 on the face of the financial statement. Let's go here, a quick concept check. Chan Inc. purchased bonds for $800,000 that have a maturity value of $900,000. Chan's journal entry to record the purchase would include a what? So the Chan purchased, they paid $800,000 for a bond, for a $900,000 bond, which means that sometime in the future, they're going to get $900,000 back. So they received a discount on the bond. So it is going to be a credit to discount. There you go.